Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I hope you're getting off to a good start of the week. Lots happening, but we had some interesting data in the US on Friday. The S&P Global PMI data, which showed that the composite index was sharply lower and in deep contraction territory. That's the economic composite PMI from S&P 500 Global. And the manufacturing index from the same people, also deep in contraction territory. Now, these are very worrying signs, and I've been warning about it all for quite some time. But the thing is, not only has the US economy already slowed significantly, it continues to slow at an alarming rate. And at some point, of course, this must begin to impact the Fed. They've already paid attention to this and mentioned it a few times that the economy is slowing and they will keep an eye on things, but they still really want to push ahead with their main game, which is to keep raising interest rates aggressively. This is making the market sentiment on stocks somewhat bearish for the moment. In fact, the US stock market's down for the last 2 weeks now, in line with our forecasts, after having got it wrong for a couple of weeks. But I think the important thing to note is that the economy is getting away from the Fed to the downside without the Fed recognizing the case. So this means the Fed, as the Fed thought inflation was transitory and it didn't need to raise rates early, slowly, huge blunder. This time around, it's not picking up that the economic slowdown in the United States is far more severe than it had anticipated and is far more widespread and becoming increasingly entrenched into the kind of downward spiral that will be difficult to reverse. So, as I actually wrote some 18 months ago now, the Fed and the RBA should be raising interest rates gently. That's June of 21, July of 21. They should be raising interest rates gently to head off inflation further down the track so they don't have to do exactly what it is they are doing now, which is to have these massively aggressive rate hike cycles at precisely the wrong time when consumers and businesses are really feeling the weight of higher prices. And as I've mentioned before, the headline inflation numbers may be coming down. We see, but core inflation is still very firm or even rising. And we get some PCE core inflation data out in the US this week, so watch out for that. But remember, the inflation headline is usually the year-on-year rate, but rates have gone up, prices have gone up and stayed up in many cases, not in all cases. Gasoline prices are back down to near where they were actually. However, they could well be going up too, because what we saw on Friday is what I have been telling you, telegraphing to you for a very long time would be the case, and that is the United States and other nations around the world would begin to play a form of defense, strategic defense for their economies, medium to long term, by increasing their oil reserves. Now, the United States has come out and said that it is going to again build up its oil reserves, but it's using the cover story of just rebuilding its emergency reserves to where they were. I wouldn't really take that at its surface sort of look. I actually think the surface of the oil reserves will be going a lot higher. I think they'll want to increase their reserves above what they had previously. Other nations, seeing this happen by the United States, why would the United States be doing this? Because it perceives there could be further supply disruption to energy supply around the world. And that means the United States doesn't want its economy impacted, so it's going to build its oil reserves at the expense of other nations, as it drives the oil price higher by doing so, but it needs to do so in order to head off any energy disruption in the future. Now, other countries around the world are going to see this, and they're going to want to build their reserves up as well. So remember, many months ago, I was talking about at some point we'll reach a situation where various nations around the world begin to compete to build their oil reserves. Well, guess what? It just started happening, but it's still in the embryonic stage, and I think the competition for oil reserves will increase. Therefore, the oil price probably is headed higher, even if China still occasionally has a COVID lockdown, as I believe there were one or two over the weekend, but where markets kind of looking past that to a general easing of COVID policy in China. Still, the other big question mark hanging over the oil price is that, as I also forecast a couple of months ago, December, January will see a very large Russian military offensive against Ukraine, unfortunately. It will be much larger numbers of troops, and the disruption that comes from that in terms of energy supply around the world could be significant, not just from any immediate impact on actual supply. We already know the gas pipeline's been blown up by someone. I think we all know who that is. But still, it will drive the oil price higher. So the United States wanted the Saudis to increase supply so they could build their reserves. The Saudis aren't increasing supply so the US can build reserves. So the US is building reserves anyway. The oil price is going to go higher. Also, too much of a global slowdown, which I think will actually intensify through 2023, has been overly priced into the oil price previously on its down move, and this rebound has plenty of upside, blue sky above it, I think, for a variety of reasons now. But do watch out for a much more significant military situation between Russia and Ukraine over the next 1 to 2 months, beginning very soon, actually. This will again put upward pressure, as I've said, on oil prices, but all of it also means downward pressure on stock prices and upward pressure on the US dollar. The US dollar has just entered the realms of being a bubble market, and I believe the bubble has further to grow. And the sorts of events that I could see unfolding strategically, both in regard to the war in Ukraine and oil, suggest a deeper economic recession for the world, certainly for the United States, Europe, and the UK going forward. And this will mean a lot more uncertainty in the minds of investors generally, which will support the US dollar to the upside. So watch for a higher US dollar, lower stocks, and a much higher oil price. And also that uncertainty could kick over into gold. So I'm a buyer of gold as well. And that's how we're likely to enter 2023. It's how we're likely to approach the upcoming holidays and through the holiday period and then into 23. As markets become a little bit thin on liquidity, what we're going to see is the underlying true fundamental forces begin to dominate. And they are, as I said, weaker economic outlook, steady core inflation or even rising, continued aggressive interest rate hikes mistakenly by central banks in the West particularly. It'll lead to a lower stock market, higher oil price, steady to higher gold, because if the US dollar is rallying, it may hold gold back a little bit, but I think only momentarily. And yes, buy the US dollar. I would still be a seller of the Australian dollar, even though today there is news of a warming of the relationship with China. That's good. I've been long been an advocate of that. The Australian dollar had a little bit of a lift on the day, but I don't see it really turning the tide here too much. The Australian dollar's, due a small bounce, but I think it is a bounce to sell. So selling Australian dollars, selling euros, selling sterling, buying oil cautiously but steadily, buying gold, definitely buying the US dollar, I think is the way ahead, and probably selling US bonds too. Thanks very much. I hope that all helps in some way. We won't get it all right, but we'll give it our best shot. All the best for the rest of your day. Clifford Bennett, Chief Economist, ACY Securities.